Friends, very good evening to all of you. I welcome you all to this day 2 of our refresher course on companies.
Chairman, I think you are facing some bandwidth issues. We are not able to hear you clearly.
I will just switch over to. Am I fine now?
It's better now. It's better now. I think you can carry on.
So we have today the important topic of loans and investments and the amendments in Private Limited Companies Act. So before I request Abhay to introduce the speaker, I will request CA Revati Raghunathan, our Regional Council member, to share her thoughts and then we take things forward. Revati ma'am, over to you.
Yeah, thank you very much, Chairman. Good evening to you. Good evening to the speakers, Mr. Manish Sampat and Abhishek, our charming secretary, and to all the members of the institute. We're back again today for this, a continuing learning session on the two important sections of Companies Act, Section 185 and 186. 185 was actually introduced as a very prohibitive section, and it deals with how, to whom we can not give a loan. The company cannot give a loan, and Section 186 deals with the, the specific limits and the other details as to the interest and other things for the loans which have to be given. We have Manish Sampat sir who is going to take us to these, I would say they are a little draconian also the way that they have been implemented. So he is going to take us in depth about it, and later on we are going to have CA Abhay Mehta who is going to talk to us about the impact of the latest amendments in the Companies Act, which is going to impact the private limited companies. We all know that the Companies Act has been decriminalized to a large extent by the latest 2019 amendment. He is going to talk to us about the impact of this particular amendment on the private companies. So hopefully the takeaway from today would be with that we will all be clear as to what are all the prohibitions, which we have to keep up with to enable our clients to go and borrow some funds or give some of their funds, because this section were introduced to prohibit the directors from misusing the funds of the company, but now certain relaxations have come in, and we have Manish sir to take us through that. So welcome everyone. Thank you. So welcome Manish sir.
Thank you. Thank you.
The secretary.
Sorry, I was in mute. Abhishek, you can introduce the speaker and then we will take things forward.
Yeah, a very good afternoon to all the viewers who have joined in today. Our dynamic chairman, K. Dungachan Jain, fellow regional council colleague, Revati ma'am, who gave a very lovely and short and brief opening address. And of course, our speaker for the day, CM Manish Sampat sir, who's an expert on this topic. I think Revati ma'am has set the tone correctly by highlighting the functions and the importance of these provisions of the Income Tax Act and of the Companies Act. And as I must also add, one very common feature that many practitioners face is the proprietor of the company or the shareholders of the company, which is essentially just the family members. They will give loans, they will take loans, and traditionally many people were doing that. Even after Companies Act 2013 has come, many people continue to do that, even though it has not been taken off for any action, etc. But it may be violative of the provisions. So therefore, understanding, and I'm sure Manish sir will also touch upon this, as to if we are currently one of your clients are in that scenario where they have failed to make the changes as required under the Act, what should you do? How you should be advising your clients, or what is your role as an auditor in this? So for that, we have an excellent speaker with us, a person of incredible pedigree, I must say. CA Manish Sampat sir. Now I have the privilege of introducing him. He's a commerce graduate from Bombay University and a chartered accountant in practice for more than 25 years. He's a partner of his own individual practice and has a staff strength of more than 500 people in his offices. He has several offices across the world: Mumbai, Baroda, Chennai, Bangalore, Ahmedabad, Delhi, Dubai, list goes on. He is a partner of the audit and assurance practice of the firm, and he specializes in the attestation functions of banks, foreign multinationals, and new age businesses in the service sector. He handles statutory audits of several large banks, listed entities, foreign companies, and even huge private companies as well. In fact, he has handled the audit of the Reserve Bank of India during the period 2013 to 2016. In fact, he is also an expert in valuations and due diligences. Of course, during his course of his illustrious career, he's been part of many groups, subcommittees, and committees at the ICAI and various other professional bodies. And one very, very important thing to share is that he's currently the chairman of the Accounting and Auditing Committee, and he is the immediate past president of the Bombay Chartered Accountants Society. As you all know, it is the most pedigree knowledge source as far as CA material is concerned, and even their magazine is loaded with enough information for us. And sir was the past president, immediate past president. He was president and helming the affairs last year. He has co-compiled the publication Mandatory Accounting Standards from Published Accounts, jointly published by BCAS and CCH. In fact, he is the honorary secretary of the Cricket Club of India Limited and was a past managing committee member of the Western India Automobile Association of India. He was a faculty at the HR College Commerce of Economics for many professional courses. In fact, he regularly delivers lectures on various topics of professional interest. It's a huge benefit and opportunity for us to have him with us. Thank you so much, Manish sir, for accepting our invitation and gracing our members with your presence and your presentation today. Welcome you, sir.
Thank you, Abhishek. Thank you for your kind words, and thank you for inviting me. I would like to start with the local, it's called, I think so what I have done is Malai Vanakkam to all of you. And thank you for calling me to address you all today. It's an honor and pleasure to be with you on this Saturday evening on a virtual meeting today. I believe it is Abhishek's birthday also, which I just had a chance to hear. So happy birthday, Abhishek, to you also. But second Saturday evening time is for family, but all of you all have been present over here. So it's honor for me. As a speaker, you always look forward for such occasions, because this is the time where you get yourself to introspect, to read through, and to refresh your own particular knowledge. And in the process of interaction with members, you also get a chance to learn. Friends, as I was introduced as the immediate past president of the Bombay Chartered Accountants Society, today's lecture is like a comeback game for me in cricket. I'm a big fan of cricket. So today it's like a comeback game for me, because since the past about 1 or 1.5 years, I had taken a sabbatical from public speaking, being my term as vice president and president of the Bombay Chartered Accountants Society, where I did just a couple of speaking assignments. But it was a pleasure to come back to SIRC and to Chennai to y'all. And when, not only, I have so many friends in this region, so many friends in Chennai, but also because I'm emotionally connected to Chennai, or Madras as it was called. So therefore, when the chairman sir called me up, I could not refuse this, tempting offer. So that's where I'm here. How am I, emotionally connected to Chennai is that Chennai was my first, as when you do your articles, you always look forward for outstation audits, because you really have fun at that time. And I'm talking about more than 27 years ago is when, first time my outstation audit was in Chennai only. And at that time I had, you could start your articleship immediately after your graduation, and then you could give your inter exam and then final exam. So I had given my inter exam, but because of death of my grandfather just 15 days before the exam, I could not do my group 2. And the results had come out when I was in Chennai, and 3-4 days had already passed, and it was just last but one day on the evening we were supposed to leave next day, and my principal forced me to go to the ICAI Bhavan at Nungambakkam, where I had checked my results. At that time there was no online results, and I had checked my results on the board. There was nobody checking the results because the results had already come out 3-4 days later. So with God's grace I had passed. So I have really fond memories of Savera Hotel and Woodlands where I used to stay, and of course, no doubt, in this type of virtual meeting, I will miss you all meeting in personal, because I believe personal meetings are much more better than these virtual meetings. But besides these type of online meetings also have their own advantages. And one of the advantages that I could have is that otherwise, had it been a normal physical meeting, I would have had to share my presentation at least 2 days in advance. But I had the liberty to share this presentation just today morning. So thank you for calling me once again. Thank you for spending your evening with me, and I hope I don't disappoint. Now, today's session, as was already told, is now I would just like to share my presentation. Is it visible? Okay. So, as was told by Revati Madam also, as was told by Abhishek also, first, the Companies Act 2013 was first notified, and all the sections were made, most of the sections were made, notified and came into effect on 1st of April 2014. But I don't know whether, the chairman, sir, intentionally or coincidentally has chosen today's date to have this session, because section 185 was actually became an act on 12th of September 2013, and today we are celebrating its 7th birthday in whatever avatar it is there today. So I don't know whether it was coincidental or whether it was intentional to have this lecture today. And as Abhishek said, that it is very typical of Indian business culture to have completely, all relying on a related party transaction. And the culture of promoters managing their own businesses is very typical to India and a few other countries. It's not there in other developing countries. So therefore, intercompany loans are part and parcel of Indian business. And we also, see even large listed companies and private limited SMEs also following these rules. So even in large listed companies, this practice is pretty much rampant. Though intercompany loans are not very favorably looked at by the regulators and the investors, but yet these practices are relevant in India. In the past also, intercompany loans have been misused, and the government wanted a tighter regulation, tighter rules, tighter provisionings to regulate this misuse. So therefore, this is the background in which Section 185 was born. And when 185 section was born and became part of Act, and it became an Act on 12th of September.
Manish,
yeah.
Yes, sorry to interrupt. The presentation is blank actually.
Yeah, I'm not moving. It's the first slide only.
Okay.
Yeah.
No, the first slide itself is not visible. No, it is not visible. If you can stop sharing and put it again.
Sure.
Yes.
Sure. Just give me a minute.
Yeah, not an issue.
Now, is it visible?
No, not yet. No.
Is it visible now?
Yeah. Now visible.
Is it moving?
Yes.
Did it move? Okay, fine. So coming back to the history of Section 185, when Section 185 was born, it was, it had a total prohibitions on loan to all directors and parties in which the directors were interested in. So at that time, it was a total ban on that. And then it was a huge hue and cry. And at that time, it was considered, it was the most hated and the most talked about provision, as Revati ma'am also said. And it was considered as one of the most dangerous and draconian provision at that time. And I would just like to share my experience with this also, is that whenever I used to, go and give lectures on Section 185, right from 2013-14 onwards, I've been started giving lectures. At that time, during interactions, the people used to be so fierce that, the people used to, get angry on me, how you could have such law, how you could have such framed, such laws, and as if that I have framed the law. So I have faced that also. So it was so much, in debate. But things have got changed. The government slowly has realized that controlling and prohibiting is not going to do, in fact, it's doing more harm and pain to genuine businessmen rather than improving the transparency and healthy business environment. Therefore, a lot of dilution has happened today, particularly in 2017. A lot of dilution has happened, and today what we see of though Section 186 has not changed much, but 185 has seen a complete sea change, and we will see what has changed. Then coming to
Manish, the screen has gone blank again. Actually, sorry to interrupt.
No problem. I'll do it. So therefore, Section 185, 186 is always taken together, and along with these section also related party Section 188 also is taken together. And there, amongst industrialists, amongst businessmen, amongst professionals, there is always a confusion, because Section 73, acceptance of deposit, those allows companies to accept deposits. It allows intercompany deposits to be given, but we also have to look at it from the opposite side. So whether loans are readily, whether they are, Section 185, 186 allows giving loans also or no. So therefore, this confusion is there amongst professionals and industrialists. So now coming back to the presentation. I'll just like to share, start with a disclaimer that these are my views and not views of the institute or of my firm. So I alone should be held responsible for this. Now, today's agenda, though we started on time, which was very good, we have only two things to discuss, that is Section 185 and 186. Though Section 185 is very short and 186, and it's as I told you now, is not that draconian. So therefore, what I will do is, just to keep on record and just for better understanding and just for refreshing ourselves, I'll just take you through a few definitions, important definitions which are covered, terms which are referred in Section 185, 186. Then we will go through Section 185 in the next 60 to 75 minutes on loans to directors, and then loans and investments by company, Section 186 will be taken. And then at the end of each session also, I have a few practical issues. Though case studies, we cannot take it in an interactive way, but I have case studies here also where I will be giving you the answers, and then I will take the questions from the floor. Now, coming to the definitions, the first definition that we will do is of relative, and the first definition of relative, it is covered in Section 185, refers to the relative. Therefore, we need to know what relative is. Though the definition of relative under the earlier Companies Act was much more wider, this Companies Act of 2013 has got a limited definition, and relative Section 277 defines relative, which talks about any person in relation to either is a member of the Hindu undivided family, is a member of the HUF, then he becomes related, or if it's a husband and wife, so therefore husband and wife becomes related, or any other person is related to in a manner as may be prescribed. And the rules prescribed only those which I have given here: father, mother, son, son's wife, daughter, daughter's husband, brothers and sister. So only these are covered in related parties and nobody else. Here also step relationships are also covered as far as relatives are concerned. Naturally, you can have a stepfather, stepmother, stepson, stepwife, but you cannot have a stepwife. Just that thing you keep in mind. Here, one more thing, a lot of things that also is a practical difficulty is that Companies Act is silent on a dependent relative. A dependent relative is maybe my retired father could be dependent on me. My wife, my minor children can be dependent on me. But in today's world, suppose if I have a brother who's living in Calcutta or is living in Chennai, and I have not met him since 1-2 years, and we hardly meet on any occasion. So he's not dependent on me. He is family, is independent, and he is invested in some company, or he's loan is given to that. Whether that will be impacted or no, that. The Companies Act is silent on dependent relatives. Then, holding company most important definition, because it is covered section 185, 186 both cover holding company relationship. And holding company in relationship to to a company means a company of which such companies are subsidiary companies. And for the purpose of this explanation, the explanation company includes body corporate. Now body corporate is what I will be covering at length. I have another definition which is covering body corporate, but the definition of holding company is simple. It is a company in which such companies are subsidiaries is. And it is important to know the definition of subsidiary and holding company. Here, whenever you are saying a company includes a body corporate, here company would mean any company which is incorporated under 2013 Act or 1956 Act, or any company which is incorporated India, or any company which is incorporated outside India also will be covered. Subsidiary. Section 287 defines a subsidiary. Earlier, prior to 2013, the Act of 1956 did not have a definition for subsidiary or a subsidiary company. 2013 Act has a definition, specific definition, and it says in relationship to any other company, that it is to say to his holding company means a company to which the holding company controls the composition of the board of directors or exercises or controls more than one half of the total voting power. So here, right from either from shareholding, the concept has moved towards control. And now all these definitions of subsidiary companies, holding companies, associate companies, joint venture companies, are in sync with the Ind AS and the sync with the accounting standards. So therefore we don't have anomalies and confusions as far as different definitions are under different regulations. So therefore a subsidiary of a company would mean whether a company or along with its subsidiaries of such holding companies controls the composition of the board. That means if the holding company or its subsidiary along with the holding company has control on who would be in the board of directors, appointment of board of directors, that control. And second thing also, that or that exercises control over one half of the total voting power, either together or by along with its one of more subsidiary companies. So therefore, earlier the definition was controls over one half of the total share capital, which has been changed to total voting power. Because in the past also we have seen where such provisions either have caused actual difficulties, hardships to genuine people, or genuine businessmen, or it has been used by some businessmen. Now here I would just like to say earlier, when it was total share capital, assuming a case where the company has got a total equity capital of 100 crores and a total preference share capital of 1000 crores. A company holds only 10% of the equity share capital which has voting rights, and it holds 100% of the preference share capital. So it will hold 1010 crores as out of the total 1100 crore capital. So it has more than 50% of the total share capital, but it did not have voting power. So therefore, to plug this gap, to loop, to have this anomaly in place, they have changed the definition. So therefore, the definition of subsidiary is that it controls more than one half of the total voting power. Also, addition over here is provided that such class or classes of holding companies may be prescribed shall not have more than layers of subsidiaries beyond such numbers as may be prescribed, and we will see in 186 that how many such layers are allowed. Then an associate. Definition of associate is referred to by section 186. An associate in relationship to another company means a company in which that company and has a significant influence, but it is not a subsidiary of that company. So that means if any company, the holding company, I have some significant influence, I can control some composition, I have significant influence, I can, get involved in the day-to-day management or maybe involved in the decision making, but I'm not having more than 51% or more than of the holding of the equity capital voting rights. So therefore I don't have that much. But here, as far as significant influence is concerned, if you have at least 20% or more of your voting power, then it will be considered as a associate company. And as far as this definition is concerned, a joint venture would also mean would also be included as an associate company. Then securities both is referred to in section 186. So we need to know what the definition of securities is. Section 281 of Company Act just says that securities would mean as defined under the Securities Contract Regulation Act under section 2. So therefore section 2 of the Securities Contract Regulation Act says that securities include shares, bonds, stocks, debentures, warrants, or any other marketable security offered by a company or a body corporate. So therefore that is the definition of securities. Then it becomes important to know the definition of body corporate or a corporation, because it has been referred to both very frequently in section 185 and 186, and we will also see that what difference it makes by being a body corporate or not being a body corporate. What difference does it make while making investments or while giving loans? So therefore a body corporate includes a company incorporated outside India, but does not include the following. It does not include a cooperative society registered under the law which regulates the cooperative societies, and any other body corporate not being a company as defined in the Act. Now the company in the Act has been defined as either a company under registered under 2013 Act, Companies Act, or earlier Act. And again repeat, if a company is registered in India or outside India in the Companies Act, the local law, then it becomes a company. So a body corporate includes any company but does not include a cooperative society and any other body corporate which the central government may notify. So this rule the central government has kept with itself, that in case it want to notify, then it can notify such companies not included in body corporate. Now, it is important to note over here that it's just a repeat of what I said. All companies registered under Companies Act 2013 and 1956 become, or earlier acts become companies. All companies registered under any act outside India also become companies. Any corporation registered under any specific law in India or abroad also become companies. Banks, public financial institutions under section 272 of the Companies Act also are body corporates, and banking companies are also. So therefore in the point number 3 over there, insurance companies would also be covered as far as those are concerned. LLPs, as far as Companies Act is concerned, LLPs are considered as companies only. We all know that we do income tax practice, and far as the tax laws are concerned, LLPs are at par with the partnership firms. But as far as Companies Act, this is the difference between LLPs, how they are treated under Income Tax Act and how they are treated under Companies Act. Under Companies Act, they are treated as corporates, as body corporate, as companies. Specifically, body corporate does not include proprietorship, partnerships, HUF, societies, and all mutual funds in India. Mutual funds managed by trustees. Why? Because in India, the mutual funds are run by the trust, managed by the trust. Therefore, they are not covered as, they are not considered as body corporates other than UTI, because UTI is incorporated under a particular act. Free reserves becomes important as far as section 186 is concerned, because it lays down the limits of which you can give loans. So free reserves would mean any reserves as per the last or latest available audited balance sheet of the company, for which are available for distribution of dividend. We are not doing this, we are not going to study this. So section 123 dividend, I don't want to get into detail that which reserves are available for declaration of dividend, which reserves are not available for declaration. But naturally, capital reserves are not available for distribution of dividends. So therefore, free reserves are those reserves. First, initially there was a lot of confusion that, so therefore there was a clarification that free reserves include all the reserves. Now with Ind AS coming, most companies adopting Ind AS becoming a reality. Therefore, these free reserves or in reserves, a lot of unrealized gains or notional gains also sit. So to have a rationalization, free reserves do not include any, provided that any amount represented by an unrealized gain or a notional gain or revaluation of asset, whether shown as a separate reserve or no, or any other change in the carrying amounts of assets and liabilities realized in equity, including the surplus of profit and loss account on measurement of assets and liabilities as fair value, shall not form part of reserve, because we know Ind AS is based on fair value, and a lot of fair value are done through, on the date of the balance sheet, on the reporting day, a lot of fair value adjustments are done through reserves. So therefore, free reserves would not include these unrealized gains or any any revaluation on account of measurement of assets or liabilities at fair value. Now coming to the chapter itself, section 185. Now again, as I said, the section 185 is it corresponds to section 295 and 296 of the earlier act. Again, it was notified as on 12th of September 2013, and there was a lot of confusion over here because government wanted to attack this at that time when they became an act. They wanted to attack all the particular loans or loans to related parties, or loans to people where directors, and loans to directors where in parties in which directors are interested. So therefore, though all other sections or many of the other sections relating to accounts became applicable from the beginning of the financial year, that is 1st of April, but this particular section became applicable from 12th of September 2013. Then in 2018, this full section 185 was substituted by a new section. The old section was substituted by the new section. So therefore, we will see that what dilution has happened in this particular act. Now, before in this particular section, before I proceed over here, I would just like to also say that section 185 gives a total prohibition, gave a total prohibition on loans to directors or parties in which the directors were interested. And section 186 gave limits within which such loans were to be given. So therefore, section 185, there was a controversy between this. So some people took a stand that, okay, 185 gives total prohibition, so you cannot give those loans to related parties or to parties in which the directors are interested. But at the same time, section 186 gives limits to which such loans are given. So therefore, such 186 gives limits. Section 186 will override 185 and you can give those loans. That was the stand which some people took. So that was the controversy between 185 and 186, because the section 185 began with, say, as otherwise provided in the act. So that was, it was, so say when otherwise provided means not, if anywhere else it is mentioned, then these provisions would not apply. So therefore, this has been done away with, but yet there is no clarity. Yet the section 185 does not begin with, notwithstanding anything covered elsewhere. So therefore, yet that limited controversy remains. Now let us see what section 185 says. Section 185 says, no company shall directly or indirectly advance any loan, including any loan represented by a book debt, to or give any guarantee or provide any security in connection with any loan taken by. So here I just want to, before we go down to what the, to whom loans cannot be given, I just want to spend, a couple of minutes on the, beginning of the section, because that will help us in understanding. No company shall directly or indirectly advance any loan, including any loan represented by book debt. So first I will spend some time on directly and indirectly. Now, directly giving loan means just transferring money into that other company's or other party's bank account, and that would mean a direct loan. Indirect loan would mean, in my view, indirect loan would mean either through a intermediary or through an agency, or a loan through an agent. That means I give it to an intermediary, and that intermediary gives to my related party or gives to the person or the director in which I'm interested in. That is called an indirect loan. Some people, took the meaning so literally, or they stretched it beyond the logical meaning, because directly, indirectly, naturally is not defined anywhere in the in the act. So therefore, but there are certain previous case laws which under Companies Act, which gave directly, indirectly. Some case laws were there which were decided. So again, going through those case laws, in my view, indirectly would not make a transaction which is not a loan, a loan. Say for example, credit extended, or a flat purchased for a director, and the director is staying in that. So that could not be considered as an indirect loan, in my view. So that is taking care of what direct and indirect means. Then I would also like to spend about what is the difference between a loan and an advance, because this is where a lot of a lot of people who in the past 5-7 years who have been speaking to me took a lot of advantage of this also. What do you mean by loan, and what do you mean by advance? A loan process, a loan would mean technically that a transaction of transferring money from one party to another, and it will again be settled by transferring the money only, irrespective of whether it is interest free, or whether it is bearing interest, or whether it's in installments, or or it is a balloon payment, or it is on bill. So therefore, a loan would mean again a transaction where money is transferred and it would come back in the form of money. But an advance, the difference between a loan and an advance is, an advance means a money is given, a transaction where money is given, but it is not going to be settled by giving the money back. It is going to be settled either by providing services or by supply of goods. So that would mean advance. Now, as far as section 185 and 186 is concerned, it is all linked with these three important transactions you should keep in mind. One is giving of loan, directly or indirectly, or represented by a book debt. Second thing is provide any guarantee. And third thing is provide any security in connection with the loan given. Now, what do you mean by guarantee? A guarantee means the holding company, or maybe a company which has a lot of fixed assets. We know a bank or a financial institution will not give a loan, a clean loan against to any company. You require some collateral, or you require some surety or some guarantee. So therefore, guarantee would mean, okay, that if the original borrower will not pay, then I stand guarantee that I will pay, make good. That is guarantee. And third thing is security, that okay, I have got tangible fixed assets, I have got land, I have got a factory building, I have got a house, that I will keep it as mortgaged as security. And then it can be movable properties also, book stock and book debts also. So that is kept as security, and loan is taken. So when I talk about 185, I might at time of going ahead, I might just say give a loan. But just keep in mind that when I say give a loan, it includes give a loan, it includes provide guarantee, and it also includes provide any security in connection of taking a loan. So therefore, coming back to the section, no company shall directly or indirectly give any loan, provide any security, or give any guarantee to any director of a company or of a holding company. So therefore, director of the company or holding company, or a partner or relative of such a director, or a firm in which such a director or his relative is a partner. So therefore, no company can give any loan only to it cannot give to a director, its director of its holding company, a partner or relative of such director, and a firm in which such a relative or a partner, such a director is a such a director or his relative is a partner. So these are the blanket No, you cannot allow. Only one thing to be just for academic interest over here, that people who are doing bank audits and people who are doing a very in knowledge of loans, they also know that there is something, a concept like letter of comfort. Letter of comfort is different from guarantee. It's a different from issue of security. So letter of comfort is nowhere mentioned in this particular section. So therefore, if a company is providing a letter of comfort, it will be out of section 185. That is my view. Purely letter of comfort and not guarantee or provide any security. Now, initially, when section 185 was there was a complete blanket ban on a company giving any loan, not only to those parties which I covered in the previous slide, but also to other parties in which the directors are interested. Now, what was defined as parties in which the directors were interested? It was the 3 bullet points over here in the top of my presentation. Any private limited company in which such a director is a director or a member. Any body corporate at the general meeting of which not less than 25% of the total voting power is controlled by such a director, or any other body corporate, board of directors are accustomed to act in accordance with the instructions of the board of directors of the lending company. So here in section 185(2), the new section, it says a company may advance any loan represented by a book debt or give any guarantee or provide any security for loans taken by directors, the parties in which the directors are interested. And these are the 3 particular parties. So therefore, a company may. And for that, what are the conditions? The conditions are that a special resolution has to be in place. That is special resolution where 75% of the members have to pass it, and naturally MGT form has to be filed, and I'm not getting into the procedural part of it, and it has to be passed at the general with the explanation notes in full disclosures, etc., etc. And the loan are utilized by the borrowing company for its principal business activities. So therefore, only if these 2 conditions are fulfilled, then a company may give any loan to any private limited company in which such a director is a director or a member, or a body corporate in which 25% of the voting is controlled by such a director, or a body corporate in which the board of directors are accustomed, or the management of those body corporates where they are taking instructions or they are working under the instructions of the board of directors of the lending company. So therefore, initially there was a total prohibition for the giving loans to the directors, relatives, partners, and of those directors, and to these particular entities. But now it is relaxed that, okay, the prohibition only remains on the directors, relatives, or partner, or the firm in which they are there. But this is relatively relaxed by saying that, okay, you can give a loan to a private limited company where such a director is a director or a member, provided you fulfill these 2 conditions. Is that clear? Fine. Now, here I would just like to spend a little bit on the loans are utilized by the borrower company for its principal business activity. Now, this is the proviso that is there, that only if the loans are utilized for, by the borrowing company for its principal business activities, then such loans will be allowed. Now, here a debate of principal business activity would mean this would hit, it would have a lot of practical difficulties also. Say a company, my client is in Tirupur and it is making a t-shirt, it has a t-shirt manufacturing unit and it is making t-shirt, but it wants to put a wind turbine for wind generation. It is genuine business activity, but it is not his principal business activity, but it's a genuine need. But as far as this section is concerned, these loans will not be allowed to be given for any activity other than its principal business activities. Here also important point to be noted is that to see what the principal business activities of the borrowing company is, one would have to go to its memorandum or articles of association and see what its principal business activity is there. Then exemptions to section 185 1 and 2 is that this is section 185(3) that if a company has given loan to its managing director or a whole time director, then section 185 will not be vitiated. You company could give, provided that it is part of his service, conditions of his service contract, and such service is extended by the company to all employees. So it should not be that only for the managing committee you have carved out such rules and you are allowing only to managing director to have this benefit, or it has pursuant to a scheme approved by members and passed by a special resolution. So a company can give a loan to a managing director or whole-time directors, provided it is covered under the conditions of service under its contract, and the company provides loan to all the employees, or a special members by a special resolutions have approved this. Or section 185 would also not apply if in the ordinary course of business, if a company in the ordinary course of business is to provide loans, it provides loans to companies and it charges interest at the prevailing yields of either 1, 3, 5 or 10 years of GSECs or the government securities, which is more comparable to the tenure. So therefore there is a complete no for interest-free loans, but provided if it is interest paying, if the company is in the ordinary course of providing loans. Now how do you determine ordinary course? What is the test for ordinary course of business? There are two tests in my view to provide ordinary course of business. One is that the company is engaged in lending, and second thing is it is giving a loan to a related party on arm's length. Had it not been a related party or the parties in which the directors are interested, and it would be unknown or unrelated parties at arm's length, same interest rate and same security provided, if it would have given, then it would mean in the ordinary course of business. Also, one more important thing over here is that the loan given or the security provided or the guarantee given by the holding company to its wholly owned subsidiary for any loan taken by the subsidiary company, or a loan taken by the subsidiary company from a bank or a financial institution. Again, here the proviso is that as far as C and D are concerned, it should be utilized for the it should be utilized by the wholly owned subsidiary only for its principal business activity. Correct? So therefore, again, just repeating or just maybe a snapshot just to conclude that, okay, section 185 exemption to any managing director, that has been covered. Any company which in the ordinary course of business gives loan, but it cannot be interest free, it has to be interest bearing and comparable to GSEC's loan, or any other loans given to wholly owned subsidiaries. Mind you, wholly owned subsidiaries, and only for the purpose of principal business activities are allowed loans to be given. So if you don't have a wholly owned subsidiary, you cannot give a loan. Now, penal provisions, I don't want to spend much time, but the penal provisions as far as contraventions of section 185 is that company shall be punishable by a fine of not less than 5 lakh, which may extend to 25 lakhs rupees also. And here again imprisonment has not gone. Imprisonment is there. Every officer in default or the director to whom such a loan is given or guarantee is provided or security is provided to him, imprisonment of 6 months or a fine, minimum fine of 5 lakhs, which may extend to 25 lakh of rupees. So therefore this was section 185 for us. Now when 185 came, as I told you, a lot of hue and cry was there, a lot of difficulty was there. So therefore, in 2014, government came out with a notification in June 2015, government came out with a notification that complete exemptions to private limited companies. Since 185 earlier section was private limited companies were out of 56 Act as far as loans were given. So therefore, genuine private limited companies, small private limited companies would be out of section 185. So section 185 would not be applicable to private limited companies, provided that no other body corporate has invested or is a shareholder of that company, or if the company if the borrowing from all banks or financial institutions or from the body corporate is not twice of the paid up share capital of 50 crores, whichever is lower, and there is no default at the time of taking such loans. So therefore, only these companies, private limited companies, where satisfy these conditions, they were exempt. So in this, many smaller companies came out, because a lot of smaller companies would not have, any body corporate invested into that. So therefore, they all were exemption. This particular exemption has not been withdrawn. So even today, this exemption is available for private limited companies who do satisfy these conditions. They can give loans to the directors. Other exemptions, of course, this is more for academic purposes. Section 185 shall not apply to government companies. There were two separate notifications. It would not apply to even Nidhi companies, as far as they satisfy these conditions. Now, case study. Well, this in the normal circumstances could have been interactive, but I will take you through this. A Limited has got two directors, AM and PM, which both hold 50% share capital each in the company, and they wish to give loans to the following and have asked us for advice whether they can do that or no. So therefore, a shareholding of 50% is not consequential, but most important over here is that they are directors and they are holding shares also. So if they were only holding shares and were not directors, then section 185 would not apply, because it would apply only to directors. So therefore, they want to give a loan to director PM. Will that apply? No, it will not be allowed. A loan to a relative of AM, again it would not. Director D, which is again the director of the holding company, again no, because you cannot give a loan to the director or director of the holding company. Or partner of a director of the holding company, again no. Partner of a director of A, again no. A firm in which PM is a partner, or a relative of a partner, a relative of a director is a partner, no. To an LLP in which PM is a partner, yes, that will be allowed, because it talks about firm and LLP is a body corporate. So therefore, if you loans to LLPs are allowed under section 185, and loan to directors of subsidiary companies again would be allowed, provided it's not a fully provided it is a wholly owned subsidiary. Now, important takeaways from here it is that initially there was no distinction between public and private limited companies, but by certain exemptions and by relaxing, private limited companies exemptions have come back. Here, as it was also mentioned, that how to rectify the mistake initially in the initial introducing 185 only, that how do you rectify? Unfortunately, section 185 does not give any way where you can rectify or remedial provisions. It does not have any remedial provision. So once you contravene provisions of section 185, then you are exposed to the risk of punishment or imprisonment. Then applicable prospectively and should not affect existing loans. So this was important, where loans given prior to 2013 or prior to 12 September 2013, when this loan when this provision became applicable, there are no such provisions. So therefore, section 185 will not apply to loans given. So at that time also, many a times people came to us for advice, or people took a very aggressive stand. What they did was, okay, they went back in the board meeting, and the loans they got sanctioned before 12 September in private limited companies, that was possible, and they just said, okay, that loans was applicable before 2013, before the section 185 became applicable, but the disbursement would happen later on, and the disbursement happened later. Then, but since it won't be applicable to loans given existing loans prior to the act coming into being, but for loans getting matured and renewals after the Companies Act, this provision becoming applicable, it would become applicable. Then again, I have also taken 2 slides on Caro reporting of section 185, 186 to make this presentation full complete. Caro reporting also has been completed, so therefore auditor in his Caro report also has to mention about compliance of section 185 and 186. So now, summing up and issues, what happens to existing loans has been covered. Is there a exemption for directors? In many cases, what happens is that a director becomes a director just as a nominee director. So is that exemption allowed? Unfortunately, there is no such exemption allowed. Then, are loans to shareholders allowed? Yes, the loans of shareholders are allowed, provided he is not a relative of or a partner of a director. Can a company give loans to HUF? No. Why? Because HUF has been covered under relative. If the director is a member of that HUF, then it will not be covered. Then what is the solution? To get exempt from there, either you have to realign or rearrange your directorship. You get new directors, remove your directors, change your shareholding, and that. Appoint new directors, either convert to LLP, and use of dependent relatives also has been covered. Now, coming to section 186. What 186 talks about is 186 deals with provisions regarding to loans and investments by companies. Section 185 talked about loans, security provided and guarantees given. Here, the term investment also has been added. So this provision governs loans and investments, security provided and guarantee given by companies. What section 186 is equivalent to section 372 of the old act. Earlier, section 372 gave a blanket exemptions to private limited companies, but mind you friends, new section 186 does not give a blanket exemption for private limited companies. So therefore, by virtue of that, all private limited companies, section 186 becomes applicable to all private limited companies. 186 says that a company shall, unless otherwise prescribed, make investments through not more than 2 layers of investment companies. So therefore, when we covered the definition of subsidiary, at that time it was said that those layers will be defined by the Companies Act. So therefore, a company shall unless otherwise prescribed, shall not make investments in more than 2 layers of investment companies. So here we will see that what are layers and what are investment companies. So therefore, imagine a situation, there is a distinction between an investment company and an operating company. An operating company would mean a manufacturing or a service providing company. So therefore, what this means is that if a holding company is there, it cannot have more than 2 layers of investment companies. And it's not necessary that whether these 2 investment companies has to be parallelly or it has to be immediately one after the other. It can be a holding company, investment company, operating company, another service company, manufacturing company, investment company, and investment company. No, it has got 3 investment companies, so that layer is not possible. Again, this is very typical to India, because a lot of Indian companies have got web of these companies. They have the holding is so complex, it becomes difficult to track the ultimate ownership. So therefore, to prevent this, this section was introduced. The exemption to this is, if the company is incorporated outside India and that that local laws allow or permit such a thing, then it can be allowed. Or the secondary, where it is in India also, it is required under some rules and regulations to have such investment company. Like for examples, in banks, sometimes it may require. So therefore, then that exemption is there. Again, as I told you initially, 186 basically talks about the limit on which the loans can be given. So here again, what it talks about is that a company cannot directly or indirectly give any loan to a person or other body corporate, or give guarantee or provide security in connection with the loan taken by the body corporate or the person, and acquire by way of subscription, purchase, or otherwise the securities of that body corporate. So here one more layer is added. Till 185 we spoke about loans given, we talked about guarantees and securities. Here it talks about subscription, purchase, or otherwise investment in any securities of the body corporate. So here it talks about limit. If it is within the limit, it is allowed, or if it is exceeding those limits, then what are the remedial procedures? So here it does not talk about only the directors, but it talks about any person. So therefore, any person, it was covered. So therefore, there was a lot of hue and cry that practical difficulties, that I cannot give loan. I mean, the company cannot give loan to its employees or what. So therefore, employees were excluded from this by virtue of the exemption, by virtue of the amendment inserted in 2018. So therefore, a person would not include any individual who is in employment. So that was exempted. Managing directors and all are not exempted in 186, but they are covered under 185, whole-time directors and managing committee and the managing director. So therefore, a company cannot give loan, invest, give guarantee, or provide any security exceeding 60% of its paid up capital plus free reserves plus securities premium account, or 100% of its free reserves and security premium, whichever is more. So if it's within this 60% or 100%, whichever is more, you are free to do anything. But if it is more than that, then what you need to do is, if the amount involved, that is what you mean by amount involved. Amount involved would mean, excuse me, amount involved would mean the aggregate loan and investment made so far, plus guarantee given so far, plus security provided so far, plus additional investment to be given. So therefore, that would mean money amounts involved. If the amount involved are more than the specific limit, then you require prior approval by a special resolution. So when I talk about special resolution, it talks about 75% of the members passing it, and a detailed explanation note, etc., that goes with the special resolution. So you require prior approval. So many companies, we saw that whenever they wanted to invest in companies, they wanted to invest, give loans, they took this permission prior approval and they kept it. So therefore, this thing is allowed. Then again, what is why, where this is not applicable? Section 186(3), that is what I spoke about, is not applicable in case of loans, guarantees, securities given to wholly owned subsidiaries or acquisitions made by holding companies by way of shares, purchase, or securities to wholly owned companies, provided 186(4) disclosure is made. So therefore, if genuinely companies who want to invest or want to give loan to, because there are many infrastructure company where you have a holding company as all other one particular in SPV, say road projects or infrastructure companies, they have a specific SPV. So therefore, SPV does not have any assets on itself, so it does not have power to raise funds, or it does not have the wherewithal to raise funds. But the holding company is sitting on a lot of assets, it can raise money. So if it has to give loans to its wholly owned subsidiaries, then this particular prior approval is not required. So therefore, mind you, one difference over here is that 185, I spoke to you wholly owned subsidiaries, but for the sole purposes of its principal business activities. Here the demarcation is that the principal business activity is not covered by 186, only it has to be satisfied. A wholly owned subsidiary, if you satisfy, then it is fine. Then another disclosure that even many of the companies and many of the auditors also miss is the disclosure under 186(4), that you might give loans under 186, it might be under within limits, or even if it is beyond limits, you have special resolutions in place. But a disclosure under 186(4) is important, which talks about any you have to give particulars the parties to which you have given the loan, at what whether it is secured or unsecured, whether at what interest rate, and what is short term or long term, and the purpose for which such loan is given is to be mentioned. Also, additional requirement under 186(5) is that it has to be approved by the board of directors, and all the directors present in that board meeting have to give their approval or consent to making this investment or giving this loan or providing this security or providing the guarantee. Next, it also talks about that if there is, subsisting of any loan from a bank or a public institution prior to the approval is required, if the term loan is, if the amounts involved, that is the loans given in the past plus the present is more than the ceiling, then prior approval is required, and if there is any default. So therefore, if it is within the limit and the borrowing is there, then there is no problem. But if the giving of the loan is or in making investments is beyond the limit, and you have a loan from a financial institution and you have defaulted, then you need a prior approval. Otherwise, you would not require a prior approval of the institution. Then it also mentions 186(6) goes and further mentions that no company registered company registered under Section 12 of the Securities and Exchange Act of India. Just 1 minute. Securities and Exchange Board of India Act 1992 shall take intercorporate loan or deposit exceeding the prescribed limits, and if it takes, then it needs to furnish the details in the financial statements. And here these companies, which would mean actually with the companies which are covered over here, would mean a registered stockbroker or a sub broker or the share transfer agent. So therefore 186 is just for academic discussion. 186(7) loans can be given under this section. No loan can be given under this section. So therefore, again, many a question that has been asked to me is that, okay, we are giving loans, we are within limits, or if we are beyond the limit also, then we have taken a special resolution. If we have a borrowing, we have taken prior permission of the borrowers also. Then what happens is, then can it be interest free? No, it cannot be interest free. Gone are those days of interest free loans. It cannot be interest free. It has to be at the interest, at least at the prevailing 1, 3 or 5 or 10 years of government securities, whichever is closest to the tenure of the loan given. Friends, here I would like to say, I have seen many companies take very aggressive stands. It is not advisable to take this stand, but what they do is that they have an agreement, a loan agreement, where this particular interest has been mentioned, but because of the difficulty at the end of the year, they take a loan waiver letter that, okay, both the directors of both the companies have agreed for this loan waiver. Please, friends, please don't advise your clients to do that, because I've seen many clients do that. It is a very debatable issue, but it cannot be, since the loan is given at an interest rate, but at the end of the year it is waived. So therefore it can be debatable, and it can land into the problem. Then the section 186(8) is again on default. Company prohibited to give loan or give any guarantee, security or acquisition still in default is substituting. So if there is any defaulting in repayment of deposits, then you cannot give any loan. So keep that in mind. Then yes, provided these such loans are given, then these are also procedural. Then register of these such loans given or guarantee or such acquisition has to be kept, and within 7 days, either in manual or e-form, and then within 7 days, sorry, please excuse me, MBP2 form has to be updated, and these, at the registered office, this register has to be kept for inspection. Whatever we discussed, section 186(2) to 186(10). Now there were a lot of, this came in much later. Section 186(11) came in much later. I think so in 2017 it was substituted. Section 186(11) was substituted. Earlier it was not there. In this form or in this avatar, a lot of genuine companies, housing finance companies, see, okay, banks. We all know that banks are say public sector banks, Bank of India, Union Bank of India are not banking companies, but private banks, HDFC Bank, ICICI Bank, all are banking companies. So therefore, banks per se would not have a problem, but banking companies are governed by Companies Act. Housing finance companies, HDFC, all are governed by Companies Act. So they had a lot of genuine difficulties while giving loans, making investments. So therefore, they made representation to the government, and therefore this particular exemption was relief was provided for these type of companies. And section 186(1) talks about 2 layers of investment companies, so that remains for everyone across. 186(2) talks about the limits and all other procedures that we saw after that, that is interest bearing, then prior approval of directors, prior approval of lending financial institutions and all. So therefore, such type of loans or guarantees or security provided by investments made by banking companies, insurance companies, housing finance companies, and bank companies engaged in the business of financing, that is NBFCs, were providing infrastructure facilities, were out of these, section 186 would not apply to them. Also, it would not apply to investments, acquisitions made by an investment company, or acquisition through subsection 1 of section 63 or rights issue, and acquisitions made by NBFCs in its ordinary course of business. So mind you, when it says acquisitions made by NBFC in its ordinary course of business, here only those NBFCs would be covered who are dealing in investments, investment NBFCs. We know that there are multiple forms of NBFCs: loan giving, accepting, loans accept, deposit accepting, core holding companies and all that. So therefore, only those NBFCs which have their principal business in the ordinary course of business, they are acquiring shares, only to them these would not apply. Here, I would also like to share, companies providing infrastructure facilities. One stand that was taken. Okay, that we will deal later. Then, coming to provisions for penalties. Okay, again, these are the provisions, penalties that has been mentioned. I will not go through that. Then section 186 would not be applicable to government companies engaged in defense production for genuine reasons, and government companies other than listed companies, in case such companies have obtained prior approval from their respective ministries or department of the central or state governments to provide any loans, then 186 would not be applicable to them. Again, this I have covered in the earlier slide when I spoke about wholly owned subsidiary. Here, as I mentioned, that I want to just again reiterate that here it does talk about principal business activities is not there. This I have covered when I covered 186.3. So therefore, acquisitions made by holding company by way of subscription purchase or securities wholly owned subsidiaries, this proviso was inserted in 2017. Now, what is remaining is that this amendment came in 2018, which spoke about what do you mean by an investment company. We already have been talking about an investment company, or 2 layers of investment company. The Act only gives a clarification that it explains an investment company would mean that an investment company would mean where it's income of more than 50% of the total assets, or more than 50% of its total income are from either dividend or deemed investments or interest income or acquisition or received of any income from shares, debentures or other securities. One point to be noted over here is that we all do, section 45(1) of the Reserve Bank of India, when even in Caro we have to report upon NBFCs. The difference between NBFCs and investment companies over here is, as far as Companies Act, it says more than 50% of its total assets or 50% of its total income comprises from these particular activities. Whereas as far as RBI Act section 45 NBFCs, it talks about more than 50% of their total assets and more than 50% of its total income. Here it says or. So here in case there it says that if you have to satisfy, if to be an NBFC, you have to satisfy both the conditions. Here to be an investment company, you have to satisfy one of the two conditions. So therefore, in one particular case of mine, we genuinely had a business where that company had, a rental income, but something happened, and that for one particular 18 months, no rental income was there. So its income from, investments became more than its rental income. So therefore, it fell into this trap of investment company. So that you have to be careful. The explanation. Companies Act also in 2018 goes ahead and explains that what would be in an infrastructure company. And infrastructure facilities would mean facilities specified in section 6 of the Companies Act, which talks about various infrastructure facilities. Here again, just to have, to share a experience, I was doing audit, or maybe of a company which, that there is this power exchange. So it was just an intermediary, like how you have a stockbroker or a sub-broker, there are power exchanges, and that particular company was a member of that power exchange, and it's, it was a part of a group where they were a power purchaser. So the thermal power generation, and they used to sell in the open market. Of course, they had that with the discoms, they have the agreement, power purchase agreement. But if there is, the offtake from discoms is less, then that particular power which has got generated, they are allowed to sell in the open market, and that open market comes through this particular exchange. So therefore, loans were given by those particular companies, and they argued that we are into this infrastructure because we are in this power. And what they quoted to me, or in fact what Schedule 6 on power says, that if a company is engaged in the generation of power by whichever way, either through thermal or through hydroelectric or through fuel or fossil fuel or thermal or solar, then or in the business of power also would mean in the business of transmission or laying transmission or trading in power by laying lines or new transmission lines. So they said that we are into trading. They said trading of power, but this particular section said that trading through laying of transmission lines. So therefore, you have to be careful that what call that particular client would take. So therefore, just to sum up what 186 says, it says that you cannot have, only the restrictions are not more than 2 layers of investment companies, no such prohibition of operating companies, and operating companies could mean manufacturing companies or service companies. Only investment companies where we saw that more than 50% of its assets or more than 50% of its total income come from such activities. Then maximum 2 layers of investment companies were allowed. Investment companies, again, I have told you what does it mean. Investments in all class of assets, as it covered like land, etc. It does investments covered as per the explanation. Investments in land would not be covered because it talks about securities and it talks about debentures and warrants, etc. Partnership firm, LLP, not governed by investments in companies. Would it be covered? It would not be. And then debate on principal business activities, that I have covered wherever I have, 2-3 times I have covered principal business activities. Now, having this slide just to understand, in the first example, we have a holding company which is holding investment company 1, investment company 2, investment company 3, and a subsidiary company. So in the first case, definitely not allowed because we are having 3 investment companies. Even though in between investment companies you would have had an operating company, it would not have made a difference. Now coming to the second example, you have an holding company, you have an investment company 1, then you have a manufacturing company, below that you have a service company, below that you have an investment company, and again a subsidiary company. This holding structure is allowed because it has only maximum 2 investment companies. Next, again in the third case, holding company, investment company 1, investment company 2, manufacturing company, service company, and subsidiary company again would be allowed because it is holding only 2 investment companies. So therefore, is private limited, we come to our basic question, just to summary, to brush up what we've done in section 186. Is private limited companies, are exemptions available under private limited companies? I'm afraid no. No such exemptions under 186 available, which were there for 185 under section 185 for those type of limited private limited companies which I told you. Is 186 applicable to all type of companies irrespective of its size? Yes, unfortunately, irrespective of all type of a size, small company or there's no such distinction, it is covered. Is loan to employees covered? As I told you initially, yes, all people were covered, but then specifically there was an clarification wherein employees are not covered. Will salary advance made by a company for only 1 or 2 months without interest come under the purview of the loan? Salary advance would not come under the purview of the loan. In unanimous consent of the board of directors required while entering into a transaction 186? Yes, all those directors who are present at the board meeting would be allowed. Then under what circumstances is the approval from the public financial institutions required? As I told you, under two requirements: if it is beyond the limit of that 60% or 100%, as I told you, and there is a continuing default, then prior permission is required. Otherwise it is not required. Can a company provide interest-free loans? I would leave it to you. Can it provide? In my view, no, it cannot provide under interest-free loan unless and until it is provided to its wholly owned subsidiary. What is the difference between a loan and an advance? It is covered. Then whether sale on credit, is it a loan? Goods sold on credit, is it a loan? No, it's not covered as loan, because if it is a normal credit, what you would have normally extended to people, it would not be covered. But if you have a beyond extended credit period, then it would be covered. Then whether book debts also considered as loan? In my view, genuine book debts would not be covered as a loan unless and until you have camouflaged it as a loans and beyond the credit period you have given. Whether investments in mutual funds are covered? In my view, no, not covered, because as I told you, in India, mutual funds are run by trusts, so therefore it won't be not be covered. Is there any cutoff limits for investments on loans given? There are no such cutoff limits. Then I always like, to have a presentation not only to disclose what the provision says, but also to end up with disclosures also. So therefore, there is a snapshot of the disclosure of the Schedule 3, which is coming. This is Division 1, applicable to non-Ind-AS companies, wherein how long-term loans and advances are to be disclosed. Those are, mentioned over here. Also you need to give further details like secured or unsecured, what are doubtful, and whether any unsecured are there, then whether loans and advances due to any directors or officers, and at what, or any jointly owned companies or any firms in which the directors are partners, they need to be given separately. And these are the disclosure. As far as the investments is concerned, you have to disclose the investments of property, equity instruments, preference shares separately, mutual funds. Then beyond that also you need to give whether they are quoted or unquoted, and if they are quoted, then what is the fair market value? If they are unquoted, whether there is a diminution other than temporary to be given. Friends, here I would also say, don't forget to disclose 186.4. This again is important, so therefore I have reiterated. Every company should disclose the details of the loan given and the members to which, and the purpose for which those loans are given, or securities provided or guarantees given. Then also CARO reporting in CARO 2016 clause 3 mentions about whether compliance of section 185, 186, but unfortunately CARO 2020, which I have purposely not covered in the slide, extends reporting by auditor beyond 185, 186, but it also talks about loans given to other parties also, all parties, in fact any persons it covers. And also, before this, I would like to spend 5-10 minutes also, because I was specifically requested by Reti Madam to cover that how loans would be, specifically in case of, where you are an RP or the company has gone into, insolvency, insolvency IBC process. How would you look at it as an auditor, or how you would look at it, as an IB professional? As an IP professional, of course, these loans which were given in the past really have to be looked with a lot of lens, because a lot of, I myself have been involved in the valuation of such companies, and in the audit of such companies, we see a lot of dirt and a lot of impairment in these particular loans, wherever loans are given to related parties and misuse of funds are there. So therefore, yes, definitely, more than 50 crores loans which are there, loan accounts which have become NPA, forensic audit would be available with the lending institutions. Forensic audit will be report will be available with the banks. You take them, you see the genuineness, and then if they need to be provided, you need to provide for it. Also, as an auditor, if you are doing audit of such a company, if these loans are not recoverable, see to it that you are making a provision for it. You are asking the company to make a provision for it. And as far as RP is concerned, if they have got no realizable value, then you need to mark that down and inform your the committee of creditors. I think so. This is what I wanted to cover. I think so. We have yet time for 5-10 minutes for question answers, and I'll be free to take any question answers which are available.
Yeah, thank you, Manish ji. I will just put the questions on the screen so that we can take it. Just give me a moment.
The first question what I can read is that definitely if she takes an advance for traveling, definitely I think that this is a genuine business advance. And if the company is providing such advance to all employees who are traveling and not particularly only to the director, then it should not be covered by 185. Again, as I told you, the distinction between advance and loan, advances are usually settled by way of providing any services or supply of goods, and loan is different. Unless and until it would be far stretched, if the intention and and usually what would happen, a traveling advance would be settled in 1 month, 2 months, 15 days. It cannot be 2 years a traveling advance is given and not settled. So that is my reply to that. The second question from Mr. Bansali is Section 185 a paper tiger, considering paper trigger, considering Section 186?
Paper tiger means it is something in power, having power.
No, I understand. Mr. Bansali, you will what I had initially said also, that the tooth of Section 185 has gone now. So if you are a private limited company or for genuine purposes you are giving, then you are allowed. So therefore, yes, now only 185, you only need to be where you are giving a loan to a director or his relative or a partner in which such a director is, or a partnership firm in which such a partner is, a director is a partner. So you need to look at it. So yes, in my view, I would say that 186 has become a little bit of toothless and has become a little more relaxed. 222 deemed dividend, read with relaxation. So what is the question here, Mr. Bansari? I didn't understand. Can you explain the implication to, 222, it's more of an income tax question, so it is out of syllabus, so I will leave it over there. But yes, definitely you need to look at it. If loans are given to directors or to shareholders where, I think so, deemed dividend, it covers, I think so, 20%. So you need to look at it also, because yes, if you see loans to directors, Section 185, whenever you do audit, this will be definitely a trigger point for 222 deemed dividend for you. Whether the exemption notified for private, yes, it is still applicable. Question number 4, it is yet still applicable and that is available. That particular exemption is not yet withdrawn. Can a private limited company extend loan at concessional rates to whole-time directors subject to special resolution? As I told you, it should be section 185. It covers managing directors and whole-time directors, and it can be at concessional rates. Whether the exemption notified for private limited company is still applicable?
I think it's a repetition.
Yes,
It's a
repetition. Can a private limited company extend loan at concessional rates to whole time? That again is repetition. 7th again is repetition, I think so. Then exemption for small medium companies from provisions of 185. See, as I covered it, 186 has got no exemptions for small or medium companies, but 185, if you fit into that private limited exemptions where no other body corporate is holding shares in you, and plus if you have your borrowing and is within the limits that has given to you, and there is no default, then you will be exempt from 185. Partnership firm, no, I'm sorry, you will be hit by 185 as far as question 9 is concerned, wherein loans given to partnership when directors or partners are common. It will be a problem. In fact, coincidentally, if a shareholder of a company is a partner, those loans will be allowed in 185. But if you are a director, then if you are a partner in that firm, that will not be allowed. When a private limited company has no activity in a year and has lent funds for interest to a company in which the director and the relatives are having 75% share, it is permissible and it is necessary that the lending company objects of the money. Yes, if they have not done anything, then you will fall under the second one. It can be given under the 185(2), so you can give loan provided it is interest bearing. Then last one, remember, in case of loan provided by a company before Companies Act of such loan is provided at lower rate. In fact, even if before the loans given before 185 came into being, even if it is given at no interest rate, would not be a problem in my view.
Abhishek, if there are any further questions after this, you can add.
Abhishek, you are on mute.
Sorry, I just unmuted. There are 2 more questions.
You can unmute yourself, Abhishek.
Am I audible now? Okay, great. So, Jagannathan asked, so you was not related to section 15 or 186. What is your view by the expression shareholders having not less than, say, 3/4 in value? Does this mean equity shares or preference shares also?
No, voting rights.
Voting rights is pretty clear there. Then Umesh Ramanathan has asked, a company gives a loan to a charitable trust in which 2 directors are trustees. Is this prohibited under section 185(1), or will this come under section 185 subsection 2?
No,
if no, then
it will be exempt, because in 185 also it talks about that you can give loans in which it includes only body corporates, and trust, as I told you, was not a body corporate. So yes, you could get away with that loan.
If no, will this come under the ambit of 186, he's asking?
186 talks about again, no, it won't come under that limit, because there also it talks about body corporate.
Okay.
It talks about any person. Sorry, it would come under. Sorry, I stand corrected. Because it would come under any person.
So therefore, if so, will interest be chargeable on this loan? This is follow-up question.
Yes. It has to be.
Thank you, sir. Then Pritika has asked, can section 185 loan be interest-free?
Again, that as I have repeated, I've been continuously saying. If you are a private limited company and you fall in that exemption, then yes, you can give that. Unless and until, if you are not a private limited company and not on the exemption, it cannot be interest-free.
Last question, G. Madhusudan Rao has asked, loans to exempt to employees. How about officers? I don't understand the question.
Oh yes, it's a good point, which I forgot one. Managers, again, which is manager is defined under Companies Act, is not covered. So you can give loan to a manager.
So here they would say CFO and company secretary.
Yes,
They fall under manager category.
Yes. They would fall under KMP, so loans to them would be no problem. But only to a whole time, I mean, manager and managing director and whole time is covered under 185. Otherwise, all employees are exempt under 186.
Yeah, there are two more questions.
We have
I like the perfect timing. I think so. It is 6:32 and.
Can a director give a loan to?
Sure. Yeah. Sorry, I did not get that question.
Can a director give a loan? One second. Can Abhishek, you can check the question of 1823.
1823. Okay. Can a director give a loan to a private limited company in kind?
In kind. See, a director can give a loan. Of course, again, this is out of syllabus, but I will cover it. It is covered under section 73, acceptance of deposits. A director can give a loan to company, provided he gives an undertaking that it is from his own funds and it is not from the borrowed funds. So if only that particular undertaking he gives and he proves that yes, this is from my own funds and I am not borrowed to give this loan, a director can give a loan to company, irrespective of whether it's a private, public, small, medium company.
Is the last question, Chairman? Should we proceed?
Yeah, that's all. Yes.
So thank you so much, Manish ji, for a very wonderful presentation and thorough presentation. Thank you so much, Chairman.
Yeah, Abhishek will right away go to session 2. Should we wait for 2 to 3 minutes so that people can get a comfort break? Okay. Manish ji, thank you so much. Excellent. Though you said it's only 2 sections, very small things are there, but you took us through a lot of small things as to the precautions what the auditor and the company also should take care. Thank you so much, Manish.
Thank you, sir. Thank you.
We'll break for 3 minutes break. We'll resume at 18:37.
Sir, I have a very close friend who is the next speaker, so I will meet him virtually and then leave.
Yeah.
Thank you.
Good evening.
Good evening. Kem cho?
First class. Yeah, it was a good presentation, Manish. Since 6 o'clock I was listening to you.
Thank you very much. Mr. Abhay Mehta is the Vice President right now of BCA.
Of BCA, correct.
Yes.
Yeah.
Very close friend.
And our immediate Vice President was earlier.
We work very closely in the accounting and auditing committee since past 10, 12 years we are together working.
Yeah.
More than that.
Yes. So how is the response to this seminar, Mr. Abhishek?
Very good response, sir. More than almost 300 registrations we have, and I think 260 people are watching live now.
Good.
So
This is the second day?
Only advantage of this is, see, Mr. Abhay Mehta, I was in a other important meeting today of BCA in the morning on brand building. So had it been physical, he could not have attended, So this is the advantage.
Yes.
And second advantage, I already mentioned in my opening remark that you can give the presentation at the last moment rather than giving it 2 days in advance.
Manish, one more advantage is people are able to ask the queries then and there.
Yes.
Generally, in the end, people don't ask questions, so we are able to cover more questions, and
yes.
people are getting more enriched on.
Correct.
Yeah.
And one more thing also good is, now, with this, people have also gone fatigued. So, sitting beyond, for a speaker also and the person who is listening also 1 hour 15, maximum 1.5 hours is, comfortable for them. Beyond that, somebody wants, attention gap span. So it's good that you have 2 speakers also. So you have variety also, and just, one person does not speak.
Yeah, in fact, Ganesan wanted me to take up both the sessions, so I told it will be difficult for me.
Abhay sir, we are chartered accountants. We want to exploit from one person rather than giving it to 2. Okay, sir, I think we'll right away go to the session 2. Manish, thank you so much. And Abhishek, we can introduce the speaker formally and then we take things forward.
It is now my pleasure and privilege to introduce our next speaker, CA Abhay Mehta. He is a FCA, he's a visa, and also has more than 28 years of experience in audit. In fact, his specialization is in corporate laws, accounting standards, internal audits, statutory audits, and of course, Ind AS and IFC implementation. He is currently, as you all heard, the Vice President of the Bombay Chartered Accounting Society for the year 2020-21, and the Honorable Treasurer he was the previous year, and before that, the Joint Secretary for the previous 2 years before that. He is a special invitee to the Accounting Standards Board of ICAI, a convener of the Accounting and Auditing Committee of the BCAS, member of the Financial Reporting Review Group constituted by the FRRB of the ICAI, resource person for the Expert Advisory Committee of ICAI, and also he is one of the compilers of the mandatory accounting standards published, I think, jointly with our previous speaker. And also he is the author for various books, various articles and publications with the BCAS. And he has delivered several lectures and seminars across India for various professionals. So this is only a brief introduction, I'm sure. We'd like to welcome you, Abhay Mehta ji, for taking time out of your schedule and joining us today. We are looking forward to your presentation.
Thank you, and my pleasure. Should I share my presentation? Hello?
So you can share it, sir. You just have to click share.
Yeah. Good evening, Chairman Mr. Gururaj Jain, Secretary Mr. Abhishek, Ms. Revati, dear friends, seniors and dear friends. Today, I'm audible, correct? Yeah, okay. So, after going through 185 and 186 sections, I have been allotted the topic of impact analysis on private companies. Company law compliance, what I thought, its title was Impact Analysis on Private Limited Companies. But then I thought that what impact analysis should I cover? So accordingly, I have included that what I am going to cover is that how the company law compliances and auditing have to be looked at with the recent changes which have come into being. And along with that, because So, because this topic would, if it had been the normal times, in the normal times, I would have dealt with the impact analysis in the light of only the recent regulatory amendments and how the corporates and auditors would deal with the changes. However, we know that we are in the midst of the outbreak of COVID-19, and it has an alarming health crisis that the world is grappling with. And apart from the human consequences of this pandemic, there is also a significant economic impact being felt globally, and the ongoing lockdown has triggered severe contraction in economic activity. And because of this, the financial reporting is also not remaining unaffected from the same. And in view of such a situation, the impact analysis has to be critically evaluated in light of the effect of pandemic on the working of companies, its reporting of events under substantially changed business scenario, and how these events have been recorded in the financials and how it will be reported by the auditors. So the basic aim of this presentation is to update with the possible areas of accounting considerations and disclosures which need to be addressed due to this outbreak. Further, to also deal with various important amendments in Companies Act and guidance by ICAI which impact compliance for 1920 and onwards. As you are aware that worldwide various accounting bodies have come out with accounting guidance or advisory. to guide preparers and the auditors on financial statements in view of the pandemic situation. And in India, our institute ICAI has also been proactive and has issued an accounting advisory. On the basis of that accounting advisory, what is felt is that these are the 6 key areas which will have to be addressed when we are finalizing, when the preparers are finalizing the account, as well as the auditors are looking at the reporting aspects for the companies which they are auditing. One is revenue recognition, second is inventory valuation, third is impairment testing. It will not be only for financial assets but also for non-financial assets. Going concern is going to be a major area where critical evaluation has to be done by the auditors, considering the situation where we are, and there are various types of businesses which may have to undergo substantial change, or there will be substantial reduction in the volume of activities, and how it is going to impact their survival. That will have to be tested. Lease is again a major player because many of the corporates are working out of lease premises. Many retail businesses are running on rental mode. And what will be the impact of the leases on this lease accounting has to be looked at. And further, lastly, financial disclosures and other considerations. Now we will deal with each of these 6 bullets separately. Coming to revenue recognition, there will have to be an evaluation of how the revenue is recognized. And as we know, amid this pandemic, contracts should be revisited for assessing its enforceability. As well as there will be many contracts where there will be negotiations and modifications which will be sought for by the parties who have entered into, by the buyers who have entered into contracts with the company. And so we have to minutely look at whether there has been any impact on the contract enforceability and thereby affecting the revenue recognition for such items. Another thing is that impact will be on revenue recognition which happens over time. Revenue recognition is normally by measuring progress towards completed satisfaction of the performance obligation. And there may be a single method of measuring progress. It may be either input method or an output method. That is on the basis of what are the, what you can say, the amount of the inputs which has gone into up to the stage of at the end of the year for the input for the what you can say fulfillment of the contract to the considering that input to the total value of the contract. On the output side also, what is the output you have received against the projected output for the whole contract? That may be also a measuring, what you can say, measuring parameter for contract revenue recognition over a period of time. Then you evaluate whether the estimated progress and revenue recognized reflect latest expectations. Because what has happened that when you had entered into the contract, you would have estimated on the basis of input method, say a contract value of my input cost to be 2 crores, and add to that my margin, I would have 2 crores 50 lakh of revenue to be recognized. Now, when you have already reached the 50% stage of the revenue recognition, and this year you have completed additional 25% work. So what you would have done that you would have added 25% of input value with the margin of that whole contract for that 25% and would like to offer that as an income. But because of the pandemic which has come in the month of March, you would have now foreseen that there would be additional costs which would have to be incurred to complete that contract. And you will have to capture, and you will have to, the preparers will have to see to it that they capture such costs into the overall revenue recognition and curtail their overall profitability from the overall contract on the basis of the additional costs which they consider will have to be incurred to complete that contract. And any changes in estimate accounted prospectively. So what just I talked about is the same aspect that whatever is the changes which are there in the estimate, we have to then get it prospectively entered into the balance contract value and accordingly would be impact on variable consideration? Many of the contracts which you have entered into, you would have considered that you will give them a discount if there is an offtake of certain amount of certain quantity of material. If there is a adherence to certain conditions which you have kept for fulfillment for the buyers. Now, considering the scenario, there may be reduced discount, reduced rebate, but at the same time, there will be demand by the buyers for the for the upliftment of the new materials to give more discount and more rebate. Considering the situation that the demand has diminished, it will be very hard for them to sell the product, and accordingly they may consider that they may come up with the additional demand for more discounts and rebates for the future. So what will happen is one is on the revenue recognition, and going forward it will have an impact on my inventory which I carry also, which I will deal with in the second slide. Again, there we have to assess the impact of non-performance. There may be penalty clauses which are there in the contract, and if your contract doesn't fit into the force majeure clause, then there will be a demand by the buyers to compensate for the compensate for the delay in the supplies and other consequences which may be there, which you are facing because of the labor disruption. And there may be demand for reduction in price, onerous provisions which may have to be considered on account of non-performance. These are the assessments which which the company will have to take into consideration while doing the revenue recognition for the March 20 ending, as well as for the first quarter which has just ended, and also the auditors who are auditing for March 20 will have to take cognizance of all these aspects when they are looking at the numbers which are given to them for audit by the auditee. Coming to the inventory valuation, there are various accounting considerations which will have to be kept in mind. One is about the impact on net realizable value. As we are aware that during the pandemic period itself, there were a huge fluctuation in the prices of crude. I will just take one example. The crude prices had gone down to less than $20. What had happened that there were various types of items which use polymer-based products. That is the items which are manufactured by using the crude, and accordingly their pricing is fixed on the basis of the pricing of the crude. So when suppose they had purchased material in the month of February, which was costing 100 rupees, they are holding that stock as on 31st of March. But that same raw material value has gone down to say 75 rupees at the end of the year. Now, when you are valuing the raw material, you will have to assess whether the fluctuation in the prices of that raw material is significant enough to be considered, because now that material which I am carrying is of value of 75, and as per the inventory valuation norms, I have to value the inventory on the cost or NRV, whichever is lower. And because the NRV has gone down substantially, and looking forward in next 6 months, if the prices are not going to recoup to the extent of the cost which you have incurred, you will have to consider the valuation of inventory at a lower value, which will have an impact on my carrying value of the inventory. Another thing is, consider the effect of events occurring after the end of the reporting period to the extent that they confirm condition existing at the reporting date. Now, I have finished goods which are lying with me. Normally, I sell those finished products at 100 rupees, whose cost is say 80 rupees. Now, because of the demand slump, because of the conditions where the transportation itself is an issue, and because I am carrying the goods which may be non-durable in nature or perishable in nature, I may not be able to continue to hold that for a substantially long period of time. And in that case, what I would have done in the first quarter itself, I would have made a distress sale of those products. Now, if that distress sales has already happened, and if you can gauge that the pricing at which the distress sale has happened is substantially lower than the cost of the goods at which the inventory is valued as on the 31st of March 20, then you will have to insist on the valuation to be lower, considering the impact of the events which have occurred subsequent to the date of the financial statement, but because we have to give a true and fair view as on the 31st of March, because that good itself has not fetched the price at which we are carrying during the current year. And there is a requirement of disclosing the write-downs of inventories recognized as an expense during the period. Now there are various professionals who are considering that if the impact of the write-down is substantial and it is one time, whether these write-downs should be considered as exceptional items. And there are many listed company financials which have come in where they have considered major write-downs because of this pandemic situation as an exceptional item. And one will have to evaluate whether this item will fall in exceptional in nature, looking at the auditee's business where you are auditing the financials. Then comes the unallocated fixed overhead. Now, I have set up a costing system on a piece rate basis where I have allocated the fixed overhead considering a particular level of production to be carried out by the company. Now, because of this pandemic, there will be a substantial reduction in the overall manufacturing activity and there will be a lower production which has happened. But my fixed costs are already fixed. So if I am going to allocate the fixed cost over the reduced inventory also, then at the same rate, then what is happening that I am trying to defer my expenses of current year and loading that excess cost on my inventory. So it would be ideal that the cost, which is an abnormal cost, should form part of the financials of the current year. A write-off has to be made, and accordingly, that additional burden should not be moved to the inventory. And there will be additional costs, whether to capitalize or expense out. Because of the substantial period of lockdown, there were the shutdown of the plants itself. Now, there are various plants which require major revamp or major maintenance for again restarting the plant. Now, if such expenses are carried out by the company may contend that because it is a major expense, I will try to add it to my property, plant and equipment as an addition to the plant. But the question here to be asked by the auditors will be whether that expenses has added to any capacity of the company's manufacturing process, or whether it has critically given any benefit in the manufacturing process to the company? No, because these are the expenses which were required just to start up the shutdown plant, and it is a maintenance cost which cannot be loaded to the property, plant and equipment or capitalized, and these will have to be expensed out. So whether to capitalize or expensing out is a decision which will have to be evaluated, and accordingly treatment should be given in the financials. Coming to the impairment, again in financial and non-financial assets will have to be tested. Here I am looking at Ind AS as well as non-Ind AS companies. Certain things are applicable only to Ind AS companies, but overall many things for non-Ind AS companies also will be applicable. In PPE and intangibles, impact on useful life and residual value. Because of the change in the pattern of the consumption, because of the reduced demand of many of the industries, evaluation will have to be done whether the plant which was being depreciated say for 10 years, whether that plant will be relevant to be operational for 10 years or its life would be now obsolete within next 5 years itself. Those, on the basis of those assessments, you will have to revisit the useful life and the residual value of those assets and then work out prospectively that what should be the depreciation which should take hit in my P&L. So that is the re-evaluation of the useful life and the residual value, and its impact has to be accounted for accordingly in the financials. There has also to be an impairment testing in India 36, as well as when we look at the normal accounting standards, ICAI, you will have to look at AS 28, impairment testing, and it provides for impairment testing of non-financial assets too. And if there is a triggering event, the current deterioration in the economic environment brings the need to revise the estimation of future cash flows and adjust the discount rate to be applied to the cash flows. So if the company feels that there is really an impairment, then it will have to revisit the cash flows which will be generated through the, what you can say, the cash generating unit, and compare it with the carrying cost of the asset. And if the carrying cost is higher than the cash flows which will be generated through that cash generating unit, then there has to be an impairment hit which has to enter my P&L. Goodwill and intangibles, these are the indefinite useful lives assets which are sitting on my book, and now they have to be very much critically evaluated for their impairment testing, because and when you see that there is a substantial reduction in the activities of the company, then you will always look at whether the CGU is giving me the enough returns or not. And if the enough returns are not coming to the business as a whole, then whatever is the reduction you consider to the returns of the business, from the returns from the business, first it has to be allocated to the goodwill and then to the remaining assets. So when you are evaluating, first you assess whether the cash generating unit is given you enough revenue to take care of the, what you can say, the goodwill or the other assets with intangibles which you have created. If not, then first give a hit to the goodwill or the other intangible assets. Coming to equity and other financial instruments, what is required under Ind AS actually will be the fair value measurement. And for level 1 and level 2, one has to look at the quoted prices at the year end. And another question, because of the substantial reduction in the prices during the, after the pandemic is at the end of the year, one has to look at whether the reduction is orderly, and hence whether it hence not fair value. This question will have to be looked at. But going by the activity or in the active market, if the item is highly liquid and highly traded, and there is a substantial reduction in the price, then you cannot say that it is not an orderly reduction in the price. So you will have to treat that as a fair value, what is there in the market, and accordingly value the financial instruments if they are covered under level 1 and level 2 of Ind AS. For level 3 investments, again, you will have to revisit the valuation considering the future projections which had been given earlier. You will have to revisit the future projections, revisit the weightage which has to be given to the cost of borrowing, and other risk factors will have to be considered. And then you work out the DCF value of that business and see to it whether that fair value is equivalent to the carrying value in my book. If not, then there may be again a impairment or reduction in the fair valuation which has to go to the financial. And again, the disclosures about key assumptions, sensitivities, and major sources of estimations and uncertainties is a must when you are doing this type of what you can say fair valuation. Then we come to the trade receivables. In trade receivables under normal accounting standards, what we have to look at is the pattern of the recoveries which has happened subsequent to the year end, and which of the customers of the company itself thinks are now doubtful of recovery, or the recovery will be very slow. In normal accounting standards, what you will have to do is that you come up with the recovery pattern and look at the doubtful trade receivables or trade receivables which may gradually become doubtful over the years, and accordingly, along with the company, take a call whether the provision for doubtful debts is required or not. But when we look at Ind AS 109 covers trade receivables and all other types of receivables which are falling as a financial instrument. And here we have to do a testing on an expected credit loss method. And here ECL expected to be based on forward-looking information and reflect probability-weighted impairment. And normally what we look at is a simplified approach where we build a table on the basis of the past recoveries and the past, non-diligent accounts which are going into a higher bucket of the non-recoverable portion, and accordingly you work out ECL provisioning on the portfolio of the whole trade receivable. But here also again, maybe a stand can be taken that the recovery which has now prolonged is a temporary situation, and the factors of discounting which you have given may be tweaked to a certain extent, so that on the basis of the management in confidence about the recovery of the future recoveries which are delayed, you may have to reset the ECL model with the probabilities being again reconsidered in light of the situation, and accordingly work out your provisioning of ECL. Because of the pandemic, the situation has become so fluid that many of the businesses are not having idea whether they will be able to survive or whether it will be able to move in that aggressive mode in next 2 to 3 years. And because of this, the testing for going concern and reporting for going concern by the auditors becomes of foremost importance. So what will have to be done for this assessment is we have to assess impact of current crisis on operations of the company. Management will need to consider the current economic uncertainty and market volatility caused by the outbreak, which has been further exacerbated by a decline in oil prices. And specific emphasis should be on assessing whether there is sufficient liquidity to continue to meet its obligations as they fall due. Liquidity is one of the very key aspects which will have to be looked at for assessing the going concern concept. Though the government has come out with various steps, and under Atmanirbhar scheme there are various measures which are being taken. There is a liquidity infusion which has been assured for the for the good account of 28% additional working capital limit being told to be released by the bankers without any further collateral. But whether even after having such funds, whether there will be a sustainability of the profitability and business going forward has to be looked at very critically. Again, you have to assess the financial challenges which will be faced. Lenders may demand new terms with higher yields or improved collateral, especially for companies in highly exposed sectors. So, the Atmanirbhar scheme talks about 20% additional working capital limit. But if there has been an ongoing expansion program by many of the companies, they have a term loan and they were looking at internal accruals for the further funding of the gap between the term loan and the cost of the project. And if that internal accruals now are going to be impacted, they may have to revisit and look at the higher loans also. So whether they will be able to mobilize the further loans which are required or not, and what will be the impact on the ongoing expansion, or whether there will be any requirement to slow down the expansion project, and if such things are happening, whether it will stress the balance sheet of the company and whether it will impact the going concern of the entity itself. Then there is a requirement of the disclosures which has been mandated or suggested by institute, that specific disclosures should be considered are explanation of how a company manages liquidity risk and disclosures of default and breakage relating to the borrowing recognized during and at the end of the reporting period. Coming to the leases, there will be a reassessment of renewals and the termination. A lessee applies judgment when identifying significant events or significant changes in circumstances that trigger reassessment of these options. So, and the lessee then considers the effect of current economic incentives to determine whether it is reasonably certain to exercise or not to because lessor will be approached by the lessee on the basis of its own business plan of sustainability for a reduction in the pricing of the rentals. And a lessee will have to evaluate what will be the best option under which it can sustain a certain level of the rentals which are already committed, or whether a reduction which he may propose to the lessor, whether lessor will accept that or not, and what will be his lessee's obligation if the lessor is not, what you can say, agreeable to the lessee's proposal. So all these things will have to be evaluated, and these accounting will have to be considered. Revision of lease terms will be required, and in fact IFRS 16 has come out with the lease accounting under COVID situation, where there are concessions already granted and how that prospectively they have to be accounted. There is a guidance, there is a what you can say amendment to the lease standard which has come, and Indian lease standard also 116 also institute has, or not institute, but the Ministry of Corporate Affairs has already issued the amendment to India's 116 also of how to account for the lease, changes in the lease terms which are favorable to the lessee, and accordingly how to account for the same has been approach has been given over India's 116 amendment. Accounting for reassessment and revised terms. So again, this is what I just mentioned, that how to account for these reassessed revised terms and the reassessed terms and conditions is given under India's 116. But under normal AS, we will have to look at what are the concessions which are given, and they will form part of the normal accounting in the particular year in which the concessions have been given. Lastly, there is a set of guidance given for financial statement disclosures and other considerations. Disclosure and presentation in financial statements will require that estimates and judgments made and uncertainties involved in each of them has to be disclosed. There has to be disclosure regarding impairments, including costs related to ECL and restructuring, and also about liquidity risk and credit risk, and how it is impacting company's capital and financial resources has to be disclosed. If the company is covered under IFC reporting, then the management needs to evaluate the impact on ICFR, because now we all know that since last 6 months the approach is work from home. The companies, executives and employees are also working from home, and all the decisions are taken through mails, through accessing their servers, or through accessing the cloud, accessing their programs and software through cloud. So what are the, what you can say, the checks and balances which the company has put in place to see to it that the controls are in place? Earlier, the controls were within the premises of the organization. All employees who were maker-checker for a particular transaction were sitting in the same premises, and the movement of the physical documents were happening between them. Now the movement of the documents are happening through scanned documents or downloads from the cloud, and accordingly the employees and the executives are giving their sanctions. So in scenario of that, there is a necessity to revisit the controls which are currently in place and whether they are effectively being applied and whether they are effectively being operated in the current scenario, and whether there is any leakage possibility is there or not. So those assessments will have to be taken, and as auditors also we all know that whatever we are doing the audit currently are also doing remotely. So our documentation of the remote access and remote calling of the data should be also in digital mode. So it is all the more important for us that how we document what we have tested, how we document what we have requested for the information. These things will be of critical importance, because otherwise we may be caught on the wrong foot of being negligent. So ICFR part is very important. One has to look at in the correct perspective, be evaluated, and whether there is any penal consequences which are coming because of the contractual arrangements by the auditee, those whether they have been accounted perfectly as provision, or whether there is any contingency, and then if so, whether the contingent liabilities for the same have been accounted accordingly. Now, Companies Act also has come up with some special COVID-19 related measures, and MCA has introduced these measures to reduce compliance burden on companies and LLCs. They have already come out with an announcement that no additional fees will be charged for late filing during a moratorium period from 1st April to 30th September 2020 in respect of any document return statement required to be filed in the MCA 21 registry irrespective of its due date. Further, the meeting of the Board of Directors normally is prescribed that the interval between two meetings should not be more than 120 days. But now that interval has been extended by 60 days for the 2 quarters, that is the quarter which ended on 30th June and for the current quarter which we are going through up to 30th September 20. SARO 2020 applicability also has been postponed by 1 year, and it will be applicable from the financial year 2021 reporting. So we will have to equip ourselves with the detailed SARO reporting which is already coming, but we will be looking at the same post addressing the COVID situation, because we are now grappling with one pandemic. We don't want to enter into a SARO which is nothing less than a pandemic for all the auditors also. Independent directors holding a meeting during financial year 1920 without the attendance of non-independent directors and members of the management will not be viewed as a violation. And a newly incorporated company has to normally file commencement of for declaration for commencement of business within 180 days of its incorporation. But here also an additional 180 days window has been given for the newly incorporated company. MCA has allowed listed and companies with 1,000 shareholders or more to conduct AGM or EGM through video conferencing and OAVM, that is video meetings, audio-video meetings, and e-voting. Highly simplified mechanism for voting through registered emails has been put in place for easy compliance. Now coming to, there are various amendments because of COVID situation under CSR provision, not only for COVID situation, majority of them are because of COVID situation. They have now enlarged the permitted activities which are eligible for CSR contribution. One is the disaster management, and pandemic is considered as a disaster management situation, along with relief, rehabilitation and reconstruction activities. There is allowability if the companies are contributing to the incubators which are funded by central and state government, and this is with the basic aim of giving impetus to the Startup India movement. Further, if the funding is going to the research in science, technology, engineering and medicine fields, which are basically aimed at promoting sustainable development goals, then also that CSR activity is, contributions are eligible for CSR. As we know that environmental protection has become one of the basic themes of worldwide organizations, and because of that only this CSR funding for research in these areas which promote sustainable development goals has been made part of CSR. Further, spending on various activities related to COVID-19 under various heads of Schedule 7 relating to promoting preventive healthcare and sanitation and disaster management have also been included. And lastly, contribution to PM CARES Fund has also been included for the purpose of CSR eligibility. Coming to further non-spending, up to now we had to just report that what is the unspent amount of CSR. But now going forward, they have come out with CSR provisions, amendments to CSR provisions, which deals with the treatment of unspent CSR amounts. Though this is still a bill, it is yet to be notified. But once it is notified, then if there is any amount which is related to the ongoing process and is unspent, then what has to be done? It has to be transferred to a special account in any scheduled bank to be called the unspent CSR account within 30 days of the expiry of the financial year. But if there is an amount which is unspent, which does not relate to any ongoing project, means you have unspent amount, but you have not identified any ongoing project to which you are going to deploy this money, then this amount will have to be transferred to a fund within a period of 6 months of the expiry of the financial year. And again, these funds, there is a direction how to utilize it. Deposited amount should be spent within 3 financial years, and any unutilized amount should be transferred to a fund specified in Schedule 7 within 30 days from the date of completion of the third financial year. And every year, there has to be a reporting of unspent amount. The board report should specify the reasons for not spending the amount. So now there is an onerous task on the board of directors to report the reasons why they are not spending on any of the objects of CSR. Coming to the directors' appointment and qualifications, there has been a recent for the 1920 year, when we are auditing the companies, what we have to look at is that the directors are active of a director of an active compliant company. And how we have to look at it is that for all the companies which were incorporated before 31st of December 2017, they were required to file the details of the company and its registered office in a form that is e-form active, which is nothing but an active company tagging in identities and verification form. And it had to be filed before 15 June 2019. Now, if the companies which were governed by this rule 25A have not filed this form, then the din of those directors who were directors of that particular company which has not filed e-form active, these all directors shall be marked as director of active non-compliant. Now, director has to take all necessary steps to ensure that all companies governed by Rule 25A, where such director has been so appointed, files e-form active, so that if one of the companies where that form has not been filed, that director doesn't make all the companies where he is a director to be a non-compliant company, director of an active non-compliant company. And after all the companies have such director files the e-form active, the dean of such director shall be marked as director of active compliance. So what we have to look at is, for a company where we are auditing, we have to see and see the information that all the directors are directors of active compliant companies or not. If not, then some of the companies where the director is a director has not complied with the filing of this e-active form, and we have to insist that you get those things resolved. An additional requirement for independent directors has now come into picture. Every independent director as on 1st December 19, and also the persons who want to become independent directors are required to comply with the requirements within 3 months from the commencement of 1st December 2020. So there is still time, but all the independent directors have to see to it that they comply with this condition. They have to mandatorily apply to Indian Institute of Corporate Affairs for inclusion of his or her name in databank for a period of 1, 5 years or lifetime. And every individual whose name is so included in the databank has to pass an online proficiency self-assessment test, which is conducted by the institute within a period of 1 year from the date of inclusion of his name in the databank, failing which his name shall stand removed from the databank of the institute. And this condition is waived for independent directors who are directors of listed companies for minimum of 10 years. Another important development for audit fraternity is the effective coming into effect of NAFRA, which has come into effect on 15th August 2019. So it is 1 year and 1 month since when NAFRA has been effective, and it has already passed 2 orders of professional misconduct. Its main mandate is to deal with the professional or other misconduct, and it requires the auditors to file annual returns by the auditors for certain types of companies only. NAFRA will have the power to debar the member or the firm from being appointed as an auditor or internal auditor or undertaking any audit in respect of financial statements or internal audit of the functions and activities of any company or body corporate, or performing any valuation for a period of 6 months to 10 years. So the powers are wide-ranging, and according to the nature and the extent of the misconduct which they perceive, they will hand out the punishment to the auditors. And filing of annual returns, every auditor of companies and bodies corporate governed by NAFRA is required to file an annual return with NAFRA on or before 30th November each year. This year, there was an extension and it was extended up to 270 days of the coming into effect of that NAFRA on the website, NAFRA form from coming into effect on the website of NAFRA, and that also has just ended last week, or I think current week. And this form NAFRA 2, what are the key details required to be filed? Included by the auditor are details of the audit plans of the auditor as covered in Rule 3.1a to D, analysis of the fees received for audit services and other services, number of companies or bodies corporate in which the auditor resigned in the past 3 years, a statement of the quality control policies and procedures of the auditor for its auditing practice during the reporting period. This becomes of paramount importance for the year ended March 20, because most of the audits are being done remotely, and we will have to prove that what are the quality control policies and procedures which have put in place to carry out the audit during the reporting period of March 20. There is related party transactions also. There are revised limits which have been put in place. At all the places, the limits now are linked to turnover and net worth, but it is one limit only. Whichever is earlier, what was there was a wherever it was 10% of net worth or 10% of turnover or 100 crores or lesser amount, whichever was lower was considered as a limit to pass the board resolution for entering into any contract or arrangement. Now, everywhere the revised limits are 10% or more of turnover. So, to that extent, there is a relaxation which has happened. So, if my turnover is substantially high, and the leasing of property is of a value which is lesser, now this whichever is lower is not there, but it is the 10% of the turnover or more. In selling and otherwise disposing of the business, buying or property of any kind directly or through appointment of agent, again, now it is 10% or more of the net worth of the company. Earlier it was 10% or more of net worth or 100 crores, whichever is lower. So a big company also for a smaller amount had to go for the board resolution. Now a very high net worth company, and if that 10% net worth is above this limit, then it will not have to go to the board for resolution. Matters included for meetings through video conferencing and or other audio-visual means. Now, to take precautionary steps to face the outbreak and reduce the movement of people, the ministry has decided to include the following matters to be dealt with in meetings through VC or OAVM. All these things are now being taken through VC or OAVM, that is approval of the audited annual financial statements, approval of the board's report, approval of the prospectus, audit committee meetings for considering financial statements including consolidated, if any, to be approved by the board, and approval of the matters related to amalgamation, merger, demerger, acquisition and takeover, ending on 30th September. Now there are changes in the appointment of company secretary and secretarial audit also. Earlier, whole-time secretary to be appointed, every listed company is required, and every other public company or private company which has a paid-up share capital greater than 10 crores. This limit has been raised from 5 crores to 10 crores. So that is a welcome change. However, in secretarial audit, even the private limited companies are now brought into the ambit of secretarial audit. Secretarial audit was applicable only to public companies having paid up share capital of 50 crore or more, or turnover of 250 crore or more. However, now what is happening is that every company, including a private company, who have outstanding loans or borrowings from banks or financial institutions, public financial institutions, of 100 crore or more are also required to get secretarial audit reports from a company secretary in practice. Now, there is another scheme which is to do with the ease of doing business for the companies has been introduced, which is called Companies Fresh Start Scheme 2020. The scheme is aimed for companies to regularize any filing related default, irrespective of duration of default, thereby enabling a fresh start as a fully compliant company. If there are inactive companies, then they can use this window and declare themselves dormant companies by filing a simple application at a normal fee. And the salient features of this scheme are that it is already in force and it is to be in force till 30th September. Maybe we will have to see whether there is any extension being granted to this, because many companies willing to avail this company's fresh start scheme would not have been able to because of the non-operational premises. They may not have been able to physically go to their office or collect the data which is required to comply with the requirements of this scheme. And any defaulting company is permitted to file belated documents which were due for filing on any given date in accordance to the provisions of this scheme. Now, Institute has also been proactive enough because of the non-movement of the people and physical meetings are not possible. What they have told is that all the members can use their electronic signature for signing all the audit reports issued pursuant to attestation engagement and certificate. So members need to ensure compliance with all the requirements relating to signatures prescribed in the law or regulation, standards on auditing, and relevant announcements or clarifications issued by ICAI on the matter, including the requirement of generation of UDIN. And requirements to mention UDIN is applicable both for manually and digitally signed reports and certificates, including certificates uploaded online. Now I deal with the guidance note on Schedule 3, that is Division 1 and Division 2, non-Indias as well as Indias companies. There are certain things which are now included in the Schedule 3, which has to be looked at when we finalize the financial statement reporting. It is mentioned that it is recommended in nature to disclose company's operating cycle. Because AS 10 has been revised with the word fixed assets words being replaced with property, plant and equipment, in the schedule itself, the word fixed assets should be replaced with property, plant and equipment. All the contractual payments should be out of the disclosure as trade payables, and they should be clubbed under others category, because trade payables are purely related to the trade of the company. Whatever parties are there with whom they have a relationship of trade, those are only to be included in trade payables, and whatever other dues are there, they have to be settled in other categories. Then there is the payment to MSMEs. For trade payables with respect to MSMEs, specific disclosures of all the details as per the MSMED Act have been added, and they have to be disclosed in that tabular format. Market value of mutual funds which are not quoted but NAV available on regular basis should be disclosed as an NAV as an additional information, though it may be carried at cost, but its NAV will give a reader an idea about what is the current realizable value of those investments. Disclosure under 186(4), which Manish covered in the earlier part, is of importance. Revenue is to be reported net of GST, because GST is not a tax on the goods, it is a collection for the supply of goods and which has to be passed on to the government. So it is a liability which is coming to us and which is sitting in my liability and cleared by payment of the same or by set off of ITC. A disclosure of profit or loss from a partnership firm or LLP, those have been given. And the finance company may disclose the following as a separate line item, that is dividend, rental income, or fees and commission income. Coming to Schedule 3, Division 2, that is Ind AS companies. Again here, in case a company is presenting condensed interim financial statement, its format should be conforming to that used in the company's most recent annual financial statement. That is, we have to follow Ind AS 34, which is interim financial statement. Disclosure for MSMEs, what we just looked at in Division 1, the same way here also we have to give the disclosure. In trade receivables, there is 2 additional categories which have been included. Trade receivables considered good unsecured were there, but now with significant increase in credit risk are to be separately shown, and which are credit impaired have to be shown. We will see in the next slide how to assess the significant increase in credit risk or which are considered as credit impaired. And in equity, description of the purposes of each reserve included under other equity to be disclosed in the notes to statement of P&L. Revised disclosure under trade receivables and loans and advances, and it has to follow Ind AS 109. That is, in disclosing trade receivables which have significant increase in credit risk, disclose the amount of trade receivables that have experienced significant increase in credit risk since initial recognition but are not credit impaired. So there is 2 categories. One is where the increase in significant risk is there but not credit impaired, and the other category is which is credit impaired. So in disclosing trade receivables credit impaired, disclose the amount of trade receivables for which it has experienced the credit default event. And the balance amount of trade receivables which have neither experienced significant increase in credit risk or significant or experienced credit default event shall be disclosed as good. So once we have what you can say taken out amounts of these 2 categories, what balance remains is good category. And the corresponding amount of provision for impairment on all the 3 categories of trade receivables, that is good, significant increase in credit risk and credit impaired, would be aggregated and presented as a separate line item below that trade receivables. Lastly, UDIN applicability has been made mandatory from 1st July 2019 by our institute, and what all categories of the certificate or the report are to be issued by generating UDIN is covered over here. One is auditor's opinion or reports issued by the practicing chartered accountant under any statute with respect to any entity or any person. Valuation report, quarterly review report, limited review report, information system audit report, revenue, credit or stock audits which are carried out for the bank, borrower monitoring assignment, GST audit report, forensic audit, concurrent or internal audit and the like, or any report of whatsoever nature issued, including transfer pricing study report, viability study report, diligence report, due diligence report, management report, etc. So I think all the things which the professional chartered accountant firm carries out and issues any report, I think 90% of the things which we issue as a report are covered for generating a UDIN. So we have to be very careful because under UDIN, as we know, there is nothing like backdated. We have to see to it that once we issue a report, or many a times we have that window of 15 days within which we can generate a UDIN number. So once we are ready with the report, first thing, without issuing the report, try to generate the UDIN and mention the UDIN in the report itself, and then only issue the report. This brings me to the end of my presentation, and I think I have not, I have substantial time left as per the allocated time, and if there are any questions, I will be glad to take up the same. Thank you.
Yeah, Abhay, there are some questions.
Yeah.
I will just share my one second. In fact, this is to the previous speaker, sir, but we would like you to answer that for this 185, 186 non-compliances, does it call for qualification in the main audit report?
Yes, I will say yes, because what if you see the main audit report, it mentions whether there are any non-compliances under this act, and if there are such non-compliances which are not covered in my CARO report or under any specific items of the audit report, then there will be a necessity to give a qualification in my audit report.
Next is, if the effect of COVID-19 is not in the financial year 2019-20 and expected for the next year 2021, shall we consider it for the report of financial year 19-20?
Basically, if the effect is not there, maybe the financials will not have that impact. But as a disclosure, you will have, as such, there is a requirement that you give a elaborate disclosure of the events which have happened subsequent to the date of the financials also. Because subsequent events, there is an accounting standard also, events occurring after the financial after the reporting date or the financial statement date. And accordingly, you will have to assess whether the events which have occurred after 31st of March 20, whether those events had a significant impact on the carrying values as on 31st March 20 or not. If not, they may not go in my financial, what you can say, the financial adjustment. But if there is an impact on my working in 2021 and going concern itself is going to be affected, then the auditor should put in a going concern para the findings that though there is no impact on the financials of 1920, but looking at the events which have occurred subsequently, there may be an impact on the going concern going forward, because audit report is being issued as on current date, and at that point in time he is already aware and equipped to assess whether there is any impact on going concern for the company. So going concern for the auditor will have to be there in assessment, and the company should ideally disclose that fact through notes to account.
Please highlight the paras of company audit report and CARO, which may generally require auditor's attention and qualification due to COVID-19.
Frankly, there are no, in fact, inventory and fixed assets. These two are the critical CARO sections, the CARO paras, where you will have to look at, because what it mentions is one is about the physical verification of the inventory. So here there will have to be suitable amendment to what you have taken inventory. Means many a times what will happen that the company has not taken physical inventory on 31st March, but subsequently after the lockdown opened, they would have taken, and there would have been a rollback, or there would have been a roll forward if the company had taken stock, say, in the month of January or February. And how that roll forward or roll back has been taken care of and the comfort which the auditor has taken, maybe the auditor will have to put it, will have to tweak that inventory physical verification para accordingly. And in fixed assets, there will not have been a physical verification of part of the assets. Maybe many a times what happens, there is a phased manner in which the physical verification of fixed assets we mentioned. So in this year, you may have to mention that during the year, for the phased manner, the part of the fixed assets which were to be covered for physical verification have not been carried out because of this pandemic. And hence, the same will be covered in the subsequent years. However, there may not be having the auditor, if they have comfort, then he may say that we don't foresee any major impact on the physical assets, physical fixed assets which the company is carrying. And otherwise, actually, everything comes in my going concern. Whatever my findings are there, if they are adverse, then it will come in my going concern. Otherwise, I don't think there is any further reporting requirement for pandemic in CARO.
Next is how are levels 1, 2, and 3 assigned?
Level 1 in India is highly liquid and traded item.
Yeah, I'll just try to get a hand on this level which is displayed. You can just confirm, Abhay.
No. I am not talking about these levels.
Okay.
I am talking about Ind AS financial instruments related levels of valuation. Level 1, level 2, and level 3. Level 1 is the most liquid and most traded item. Level 2 is less liquid items, and 3 level is the illiquid item, where you will have to call for the valuation, fair valuation on the basis of through a valuation report. I am talking about those valuations.
Okay. Why financial assets are considered for level 3 and not for level 1 and 2?
No. Financial assets fall in all the 3 categories. That's what I'm telling. That financial instruments will be either level 1, level 2, or level 3. If I am holding equity shares of a listed entity, then they become level 1 valuation, level 1 item to be valued. And how it is to be valued, the guidance is given that you have to take the market price on 31st of March, which is prevailing. Level 2 may be NAV based items, like mutual funds. They are not quoted, but their NAV is daily published. So I will take the level 2 as a benchmark price is available publicly, and I can take the comfort of that value. But I have an investment in a private limited company, and it is nowhere listed, or private limited company as it is not listed, but it is not, we cannot assess a value to that illiquid item. So what we have to do as an auditor, I will call for a valuation report, and it may be on the basis of a fair valuation which is worked out on the basis of the accepted valuation norm. It may be DCF valuation or any internationally accepted valuation norm, and that value auditor has to take a comfort whether this is the correct valuation or not, and then that price is put in as a fair value of that instrument.
And next is effective date of applicability of secretarial audit for private companies whose borrowing exceeds the limit.
I'm not readily having that effective date, but it has come during this 1920 financial year itself. So all the companies which are having that borrowing in March 20 will be covered.
Okay, there are 2 questions relating to UDIN. Murli Krishna has asked, is it mandatory to generate UDIN while certifying in MCA forms by appending digital signature? Chandramouli Vengaldas has also asked the same question. I think the Institute FAQ has told very clearly you cannot append it, you keep it in your records. That's all.
Correct. In fact, for 15 CACB also, for remittances, there is no place in 15 CB to incorporate that UDIN number.
In fact, to put it in a nutshell, anywhere, even if you are not able to append it, where you are signing it digitally, you have to generate UDIN. Any attestation you are carrying, UDIN is compulsory. Quoting, not quoting is, kind of comfort which you are having. And I always tell Abhay, whenever you are in doubt, please generate UDIN, nobody will ask you why you generate that.
Perfect, sir. In fact, what is happening is this is a self-check, and Institute no. See, the authority to which you have generated and uploaded the document, it has a digital signature. What is required, the purpose of UDIN, we have to understand that it is fraudulent misuse of our signature should not be done by any other professional or any other company. So it is protecting us that UDIN is there. So we have to be very cautious that whatever certificate I issue, I should ensure that it is there on the institute portal. So even in future, if any certificate which is there of my signature coming to me and disciplinary action comes on me, I will always try to protect that I have not generated UDIN for this. So this is not this is a fraudulent thing which has happened.
So screen sharing is sir. How can you just reshare it again?
Pardon?
No, screen sharing not required, Selva. Not required. Yeah, next is a private limited company has borrowed a loan from another private limited company which has been closed during the year itself. Is there any requirement of reporting as an auditor?
If we go really by the spirit of the section, you have to report. Okay. But if it is very temporary, you can take a lenient view.
Okay. It's a judgmental call you need to take.
Yes.
I think we have covered.
How comfortable one is with the non-compliance? One's risk appetite is tested over here.
We have covered all the questions, and I'm just sharing the feedback link and the PPT and other links which members can make use of it. Do not forget to give the feedback so that we can pass it on to the speakers, and it is for us also to know.
And another thing is, thanks to an opportunity given by the SIRC to me, and I'm really grateful that I have been able to share my views, and I hope that I have been able to come to the level at which you were expecting me to deliver the lecture.
Thank you so much, Abhay. In fact, to quote C.A. Shankar AM has put in the chat box, thank you, sir. It was crisp and wonderful. It was indeed very crisp, to the point, and excellent 3 hours of session where we'll kind of know how to do the audit, company audit better. So thank you so much, Abhay.
Thank you so much. My pleasure. My pleasure. Thank you.
And future programs we already hosted in our website. There's a program on 14th of September on standards on auditing. On 19th of September, there is a program for members in industry managing the COVID. And on 23rd to 26th, we have a program on GST. I request all the members to kindly register for the program and be benefited. Thank you all of you.